Hello, folks. Bill and Brian here with Energy Road with this week's update. And so today we're going to be talking a little bit about inflation, and we're not talking about volleyballs.
No. Well, here's the thing. Inflation has been a topic of conversation because that's what has happened ever since COVID. So COVID was very interesting on a deflationary, but we're going to take a look at history, crude oil price, and inflation. And if you stick around, we're gonna talk for about 20 minutes or so. Keep it open about 10 minutes for questions. So if you're curious about inflation and what that means for energy prices, stick around. And until then, here's here's a little video intro. That thing gets me pumped up every time.
Exactly. And I tell you what, folks, we're going to introduce something a little bit different this session. We're going to introduce the Snicker Bar Index.
Snicker Bar Index. I'm in for that.
As I refer to it as the SBI. So
I love that. So we're going to save our commercial for a little bit later, but what we're going to talk about is I found this chart out there. Let me blow this up just a little bit. This is very interesting. This is not WTI crude. This is considered Illinois sweet crude price. This on inflationdata.com, and they created this in December. There's been a lot of conversation inside of our community, inside of Rogue Edge, where we've talked about inflation and what does crude price mean. And a lot of it depends on at what point you're looking at it. Is it today looking backwards? Is it yesterday looking forwards? So we're gonna look at both. But what's interesting is if you look at this chart, this has an average inflation adjusted crude price from 1946 to 2023 of 54.90. So 54.90 is what is inflation adjusted since 1946. And then you take a look at since 1980, 67.74. Then you take a look at 2000 to today, you're at 76.30. So what we did is we took a look at WTI crude and we went back through history and took a look at what crude price was in 1985, 90, 95, 2000, 2005, 2010, 2015, and 2020. So what we did is we took the crude oil price from that point in time and then factored it based upon average inflation rates and what crude price, quote unquote, should be today. So in 1985 prices, crude oil price should be $79.94, whereas 1995 prices at 1840, we should be at 37.24. Is that right, Bill?
Right. So what you're looking at there, folks, is that saying, well, and the way that we sort of put it, if we were selling crude oil in $1995, it would be worth $37.24.
Right.
So the key to this is you got to look over there at the money supply and see how much the money supply has grown. And that's that is what gives you some context.
Well, or put simply, if you have $1 today, and then the money supply increases tenfold, and it's $10, is the price of products the same? And in most logical economic books. I studied economics in college. The fact is, when you increase the money supply, the value of all the other products go up proportionally. But you don't see that with crude. That's what's
Right.
interesting. Now, why wouldn't we see that with crude, Bill?
Well, I think one is when you look at money supply increase, that is the U.S. thing. Crude is an international product, and
Right.
so you're now is what you're looking at is not just what's happening in the U.S., but what's happening in everybody else's economy and what they can do for it. It's and a good example of this. When we start talking about crude oil, is the top 10 crude oil producers in the world are not private companies; they're all state-owned companies. And so they have a different economic incentive than a private company.
Yeah. Yeah. I mean, it's interesting because as the United States has become a global crude player and now a global LNG player,
That's correct.
we 10 years ago we were non-existent. And
Well,
Christian,
shoot,
hey,
5 years ago we were non-existent.
yeah. And Christian will come back to this and say a little bit about that. We're going to stick on inflation for a little bit, so you can either stick around with us or you can watch the recording. Probably about minute 20, we'll hop back into that, or that's what we'll try to do. So,
Anyway,
and
I
Giorgio,
was going to say that's pretty impressive, Brian.
what's
You
that?
know where we're going. I'm sitting there going, huh? Minute
There.
20?
And Giorgio, good to see you. Always great to see you out there. So listen, we'll come back to natural gas production from oil rigs and so on and so forth because
So
I
let's get some relevance here. So let's talk about we're going to talk about candy bars first, then I'll tell you about the Snicker bar index. So basically, when you looked at candy bars and what they sold for and all these different time frames, so from 1985 to 2020, the actual price of a candy bar on a per ounce basis has over doubled.
right.
And so if that was the case, we would be, inflation wise, we would be there. But what it boils down to is that it's not a direct comparison to a domestic inflationary uh, commodity group.
Well,
It's
you could also see that because based upon the money supply, it should be 7 times that. So what's
right,
interesting is the value of the money supply should go 1 to 1 to the price of products. But this is why commodities and commodity prices are such a unique perspective because they interface on monetary issues, supply issues, demand issues, storage issues, and policy issues, and
right,
geopolitics. All those, right? Did I
right.
miss
It,
any?
it, it also assumes that the scarcity is going to be the same as it was in 1985. As you find more of the commodity, it's not as much scarce. The price will go down in the open
Hmm.
market. And with all the technological advances we have, especially when you start talking about horizontal drilling and fracking, you are now starting to see a whole lot more variables introduced into the equation.
Yep.
So
And hey, Richard, how are you? Good to see you. Sorry we missed you at NAPE. We were in the same building, but just didn't see each other. So,
same very large building. Yeah.
hopefully, yeah, hopefully next time. So, anyway, so the point is that there's a lot of volatility on crude prices and natural gas prices. And what could be driving some of that volatility, Bill?
Well, I mean, a lot of it is the fact that we on the way down is the availability of supply. On the way up, it's usually the increase in demand. I mean, that's typically and how those are volatile to one another is how that works. So
So wait a
if we got
second,
a
you're saying on the way down. So as the price moves down, there's more concern on supply.
no, there's more supply.
There's more supply. Oh, okay, okay.
And so the volatility goes up and down based on how that supply, just how much more do we have? Um, it's interesting. 20 years ago, we didn't have the transparency we have on shipping, like shipping of crude oil. We didn't know where the ships were coming, where they're going. Now you can track them off your phone. And
Yeah.
so that changes that transparency changes how it's reacted in the market.
Yeah.
We learned a long time ago, Brian, that transparency shrinks margins.
Yeah. Well, I mean, the fact of the matter is that when you look at, and one of the things that we've discussed in our community is what the price of natural gas next month might not be relevant to next year. It does have a relationship, but the correlation is not one to one. So, but the main point in this, the main point where we're trying to go, if you look at different inflection points in time, the average of these periods, and these are just snapshot years, the average for WTI since 1985, which the NYMEX contract was active for, is $67.71. That actually sounds coincidentally remarkably accurate. Whereas you have the low price in the 30s, the high price in the 112s. So coincidentally, this is a decent long-term range of crude oil depending on supply and demand. Now, there's a lot of questions on what the future supply and demand scenario may be, and that's part of the reason we'll save the commercial for a bit.
Right.
But that's part of the reason that we established Energy Rogue. And
Brian, I think the average gas price here is one of the things that sort of shocked me when we started looking at that time frame the last 20 years.
Yeah.
That's a pretty high gas price being on
Well,
average.
what skews it up are three periods: 2000, 2005, and 2010. Now, what's interesting about the history of that, in 2000 to 2005, during that time frame, we were building LNG import facilities because we did
Right.
not have enough natural gas.
That's why
So that's
Cheniere down in the Gulf Coast was built as an import facility.
so 20 years sounds like a long time for supply demand to change. That is actually relatively short for infrastructure like this. When you have a new LNG export facility announced, it's probably going to be 5 to 7 years before you actually see it.
Right.
So production can happen a lot quicker. When Bill and I started the industry, demand moved faster than supply. It took a lot longer to build up supply. And now it's inversed to where demand moves slower than supply. We can bring it on awfully quick.
Yeah. I mean, my first job by throwing dinosaurs in tar pits, that job has been replaced now with the drill bit. And so I think that's why it's probably sped up, Brian, is because,
Yeah.
Getting a dinosaur in a tar pit is not an easy thing.
So anyway, what we wanted to point out here, and we'll kind of close off the inflation discussion, then get back to some of the latest statistics on the market and whatnot, because I know Christian's hanging around to watch this. But when we close this off, what can impact crude oil price? What can impact natural gas price? Both of these are impacted by the money supply, by financial policy, strength of the dollar, supply, demand, imports, exports, storage. What am I missing? Anything
Well,
else?
I think what's interesting is what's affecting the crude oil supply, I think, is now there's a competitor to OPEC called BRICS.
Mm-hmm.
And I think this is going to bring a whole new dynamic to the market. And the fact that when you start talking about the strength of the dollar, if we're looking at going off the petrodollar, and I don't know that it'll disappear completely. I just think that not everything will be based on it, and that's going to change. It's going to increase some volatility in there in currency exchange, if nothing else.
Well, we'll save that discussion for another day because that's not going to happen in 6 minutes. That's going to happen. I mean, that's a very long thesis. And let us know in the comments below what you want to see topics on, what we We typically talk about things in the market, but this is a topic of conversation that we've had in our community, and we thought we would share it because we find it very interesting, fascinating, and useful. So,
So you want to talk about the SBI,
the what?
the
Snicker?
SBI,
Yeah,
the Snickers Bars
tell us.
Index.
Tell us about
So,
Snickers.
so interesting enough, I use it to look at natural gas. So natural gas right now is trading negatively to the Snicker Bar Index.
Yeah,
And the reason I use the Snicker Bar Index is because I like doing the research. And so
right.
that means I have to go buy a Snickers bar to make sure. So Snicker Bar Index is based on the price of a Snicker bar, regular, not double, regular Snicker bar.
What was
At
it
a,
in 2000? Do you have that?
I do not have the 2000.
You
I think
you you have 1985.
the 2000. Let's see. I think I may have
And
it.
if anybody knows this, drop it in the comments. I'd love to know what the Snicker
Dollars.
bars
It was
cost.
in 2000. It looks like it was about 85 cents.
And what is it today?
Today, the my research tells me that it's $1.89. So it's over doubled since then. And so the SBI, when you and current price in natural gas, Brian, what did we see today? $1.50 or close to it.
So on the Snicker bar index, natural gas should be $9.58.
There you
Fun
go.
fact. Fun
Fun
fact.
fact.
So anyway, I am going to do a quick commercial, and then Christian, we're going to get back to your question. And feel free to ask any questions. This is a long topic, and of course, we're just trying to touch on it in the live stream. But when Bill and I have been in the energy industry a very, very long time, and we've traded energy commodities, and we've realized that information is important. Supply, demand, imports, exports, storage, stocks, all of this will have an impact. As a matter of fact, today, crude oil, you can see, dropped off. The reason why, we added 12 million barrels to storage, to stocks. So, if you go to energyrogue.com, there is a link down below, and you click on register. I'm going to give you an overview in that registration about the difference between Rogue Edge and Rogue Premium. Rogue Edge, put simply, provides access to over 150 charts that are interactive, downloadable, a daily email, weekly video recaps, a weekly PDF, daily support and resistance, and insight into potential moves on the market. And it's only $89 a month. There's no long-term commitment. However, if you do sign up annually, you can get $79 a month. You got to pay annually, though. And then our Rogue Premium is something we just launched, and this was what we detected. A lot of people want a little bit more custom insight. So this gives access to our Discord channel, which is right here where we talk about things in the market. For example, we were talking about the average lateral length in the Haynesville, and this has an impact to cost, and that cost impacts the economics, which tells us how much future drilling is going to be taking place. So that was just a conversation from this morning. So we talk about the market on the day, what might be happening. For example, we talk about crude stocks and natural gas storage and things like that. And as we look at seasonality, we also try and have some fun where the bulls are having a hard time getting up on natural gas. So our private Discord channel gives you access to that. Inside the week video updates, which usually is about 3, and then in week video updates, Q&A with Bill and Brian. So if you're looking at something, whether it be a trade, whether it be an investment, whether it be a physical asset, we will engage with you. You could set a meeting with us and we'll talk to you about it. So anyway, that's what we have is Rogue Edge, Rogue Premium. It's a pittance of a cost. Everybody that has signed up said you should be charging more, but this is a company that we came up with and we are not backed by private equity. Well, we're backed by our own private equity,
Very private equity.
Bill and Brian's private equity.
That's right.
So, and we did that because we're in control of the pricing so that all of this can be available at a very affordable price. So that's what we're looking at.
And it's important to know that in the Discord channel, it's not just us. We take the opinions and the expertise of everyone in that Discord channel, which gives us collectively a much higher intelligence. Believe
for
me.
example, this was shared by one of our members today, as well as some technicals. That this was shared as far as budgets for some of the operators. So we look at a lot of different aspects of the business.
It's worth the money just to be part of the Discord channel. But
so
when you put everything all together, let me tell you something. It's hard to beat. It's hard to beat.
Yep. So anyway, would love to see inside. If it's not for you, no big deal. But let's get back to Christian's question, which Christian, what is the percentage of natural gas from oil rigs? And do you see that slowing down natural gas production? So that's actually a very insightful question here. And let me dive into this chart because this will help show that for you. Let me size this up. And we're talking natural gas, right, Bill?
We are talking natural gas. And so what the big change in natural gas obviously is the Permian. Because most of the dry gas plays are not really going straight because the Permian has associated gas. What that means, it's associated with the crude oil production. So that they're going to produce crude oil and they're going to sell nat gas for whatever they can sell nat gas for, but they're going to produce the crude oil. So that,
or said a different way, if it costs them money to dispose of the product, that they'll dispose of it because they care about the oil, not the gas in the Permian. Right, Bill?
Right. And so Christian's follow-up question is interesting when he's talking
well,
about
let me get the first one. Let's answer the first one, then we'll get to the follow-up. So the first one is, Christian, this is a chart where we track on a monthly basis the production in each shale region. Now, every well can be different. It could be a gas well, it can be an oil well, but generally speaking, that holistically, when you have the Permian, which is this darker blue down here, that is an oil well. Then right above that, you have the Niobrara. That is an oil well. Above that, you have Haynesville, which is a gas well. And above that, you have Eagleford, which is kind of mixed between the two. Bakken, which is going to be oil. Marcellus Utica, mostly gas, almost all gas, natural gas liquids. But let's take a look at just the oil basins. So I'm going to take off Haynesville, take off this, take off Anadarko. Eagleford is really just such a mixed bag. I'm going to take it off for this analysis. So this is how much gas has grown since 2008 on
out
these
of the
basins.
oil basins. Yeah, out of the oil basins.
But let's take a look at since 2018, because I think that's going to be even more important. So you can look since 2018, so 6 years ago, we grew from roughly 15 to over 30. So as long as oil economics support that, then they will continue to grow. However, this is where it gets nuanced, and this is part of the reason that we talk about things like this in our Discord channel. So there's more gas coming out. It's because of the volume of oil that is coming out, but they are drilling longer laterals, which means it costs more money to produce. So if you have flat to declining oil prices, it is not gonna look good, and you will have this dynamic, which is something that, again, we've been watching. Since May of last year, this is what's happened to rigs. We have dropped and we have not recovered. So our rigs, the productive capacity is going to be reducing. So let me go back down here. So what we track every week, we track let me do this one. No, I'm going to leave the Bakken. So this is how much shale decline happens in those basins. So you have close to a BCF a day, 800,000 a day that declines every single month. So that means they have to replace close to a BCF a day. And then we track new production by the basin. So to answer your question, it is slowing down. Let's take a look at the Permian rigs. So if we just look at the oil rigs, we have dropped, and there's usually delayed impact when you drop a rig. You're going to see the impact 3 months to 12 months. And this part of the reason that we've been talking supply is going to be tipping. It's held up so far, but it is going to be tipping. So before I get on to the follow-up question, did I miss anything there, Bill?
I don't think so. I think it's important to realize is that as the laterals get longer, it's not a 1-to-1 ratio. The further out you go, you don't get the same amount of oil. You do get a significant amount of oil, but it becomes less and less efficient the longer you go out. And what you saw there was about 2 miles out. They are now playing with 3 miles out, and we'll see how well that goes.
Yep. So let's get to the follow-up question. Wondering, do natural gas producers turn off the tap? Can they turn off the tap? Is it possible? And how long they can keep this price? So that's a nuanced question. And again, I'm not trying to sell. I'm just trying to offer. We do discuss that in our Discord channel because that is a very industry-specific question. There are some reservoirs where you can actually look and evaluate and turn off the valve at the surface and leave it in the ground. However, think about there is a lot of pressure under the ground when these wells come up. So when they do that, it changes the pressure underneath, which could impact the next 15 years of production.
And most
So
of that depends on the reservoir pressure to begin with. And so
often a producer will look at, well, what is my price this month over next month, and then into next year, because it's probably going to be a longer question there.
and
And
the other
we got James. Hey, James, how are you?
and so some of the things that there's a competitive perspective to this as well, because
Yes.
there are people who are, let's say what they're trying to do is so let's say Brian and I are two producers, we're side by side. Brian says, listen, I don't think this is worth me producing it. I'm going to shut in. And I'm going, you know what? I have different economics. I'm going to hit that zone and I'm going to produce as much as possible. Well, now all of a sudden I could be draining Brian because he's not producing.
Yep.
So when he goes back to get his well, there may not be as much gas there as was before, because I was basically able to drain him with my well. So there's a lot. It's not a simple turning on the tap and turning off the tap. There's a lot more that goes into that decision.
But I will to answer your question. So back in 2020, when we had COVID, we had a very big supply and demand shock at the same time. So when we take a look at what happened during COVID, I see this as a good proxy. So there were a lot of shutdowns, and those shutdowns took place from April to May. So let's take a look at production back in, I'm going to take it to February. February production was around 94.7. And then when we dropped in COVID in May, we dropped to about 89, kind of 89. So we dropped 4 to 5 BCF a day. So relatively speaking, it's probably going to be less than 10% that can go offline. Now that 5 BCF a day or 6 BCF a day that I'm talking about, some of which is because they couldn't get field crews to bring on new production. So not
Right.
all of it is turning it off. I would venture to guess on the 2019 numbers, probably 2 to 3 BCF a day or less than 3% of the market could be turned off. So I don't think a lot of the production, and it has to do with they're concerned about damaging the reservoir and the dynamic that Bill was talking about. There's a little bit of a race. Hopefully that
So,
answers the
and the
question.
other thing about this is a lot of people say, well, how can they produce at this price? Don't forget, these producers hedge their commodities. So depending on what their hedge price is at, they're not getting the current price you're seeing in NYMEX. They're getting a price that's associated with their hedges. And so you've got to play that into consideration as well. They can go a lot longer if they hedge it at a lot higher price.
So what Bill's talking about is that they
And we
go
talked
out
about
and
that in Discord today.
yep, and what they talk about is in 2025, which is the orange line here, this is the monthly distribution of what a producer could hedge for. So this gives them the attribute uh, to really smooth out their economics. Now that's not
Right.
going to be at their location. This is for NYMEX, and again, apologies for the cough. I caught the COVID. I'm going viral today. So anyway, we told ourselves that we had to work that in somehow. But this is the strip price that a producer could go out and roughly get for their natural gas, right, Bill?
Right. So what you do is that they usually hedge, at least when I was working for a producer and we were looking at when I was looking at the hedges, we'd always look at anywhere from 2 to 5 years out. And then what we would do is that we would hedge NYMEX, then we would also hedge basis. And the,
Yes.
the, the general rule of thumb is when the price is up, you hedge NYMEX. When the price is down, you hedge basis. That's typically
Right.
how that does because the basis shrinks during that time. And so the idea is always get the highest NYMEX price, the lowest basis price. And
Yeah.
so, but we're always looking 3 to 5 years out because of debt covenants. And I tell you what, we go through this in a lot more detail. I don't think we need to go through all that much detail now, but just realize that there are other reasons for producing in a low price environment.
There's a lot of nuance to this, and if you want to learn a little bit more, reach out to us, connect to us. I think there is a link to either email us. You can even book a meeting if you want to learn a little bit more about Rogue Edge or Rogue. So listen, I will say this: Christian is trying to figure out how long. Okay, that's a great question because this is at the intersection of supply, demand, imports, exports, storage stocks, and also I'm going to introduce you to James at Arcus FX. There's a dynamic on the trading side for technical analysis, and he has a service that looks at the technicals. We look at the technicals as well, but that is his specialty, and he is somebody that really is phenomenal. And when you talk about price targets, he has a very good platform for that.
And
So
then on top of that, he's an overall good guy.
yeah, yeah, and he's an overall good guy. So listen, I think I will go ahead and show you this. This is just my technical view. I will leave it to James to tell me if I'm off base or wrong. There is a continual channel down. This $61.1 is a level that I've been watching. And if this breaks 148 stands out. I think James said that there might be even a lower, longer term target at $1.29. But again, I'd leave that up to James to speak for himself. From all the energy markets, we connect with energy markets here internationally out of out of the Middle East, Asia, Europe, and the United States, this is overdone.
Yeah.
Now, the question is how long can the $1.60 stay? And as James put out, there is a possibility we could go even lower. That said, when we reconcile, there will be a reconcile towards the upside. Now, how much? Let's take a look at this. This is the futures contracts. And in November, we're at $2.86. In December, $3.39. Now, I can guarantee you when we get there, it's not going to be that price. It's going to be different. So I don't want to promise that, but that's what the futures market already has.
So just
So,
remember that the market can always remain illogical longer than you can remain liquid.
yeah. So listen, I think that's all we had. There is information down below. Would love to see you join us. We've been growing, and thank you if you're watching and you're a member. Really appreciate you. And we're looking forward to an awesome 2024. And any other closing thoughts, Bill?
No, I just think it's going to be really volatile for the next few weeks, especially in that gas. And we're not seeing a lot of weather coming in. And I'm sure we'll have one more sustainable cold spell, and which will give us a little bit. But we're going to come out of storage pretty high as an average, and that's going to make it set up for an interesting summer.
Yep. So listen, folks, thanks so much. Really appreciate it. And again, there's information down below. Would love to see you inside. Would love to connect with you. So until next week, we will see you soon. Stay safe. Be safe. What do you always say?
Be kind, stay safe, and hey, go rogue with us.
Yeah. So listen, folks, thanks so much. Hope you have a great day. Talk to you soon.